Good afternoon, everybody. Mark Panazon here, mortgage broker and partner with Mortgage Connection. Hope you're having a great day. It's this month's update, technical analysis update email. So hopefully you find this information useful. As always, we're going to start with the charts. So we have the three main indicators lined up once again for you. We have the inflation black line, we have the Bank of Canada overnight rate red line, and then we have the Canada 5-year bond yield, which is the yellow line. If you remember, the 5-year bond yield is essentially the a leading indicator for where 5-year fixed rates are going. The overnight lending rate is an indicator of what variable rates and all floating type rates will do. And of course, inflation controls everything. So this is the monthly chart. So if we zoom in, based on what's happened from last month to this month, we've seen a slight tick up in inflation. We were at 2.8% last month. We've ticked up to 2.9% in inflation. So with that news of inflation slightly raising, no movement, no action by the Bank of Canada. They met about 10 days ago and decided to not move rates again. So now we've seen rates not move since July of last year. We're coming up on a year when we think the rates will finally start coming down. So variable rates still a little bit higher than fixed rates. We're looking at roughly 2%-ish higher than the current fixed rates. I'm sorry, about 1.5% higher, 3.5% from 5%. So traditionally, variable rates haven't been higher than fixed rates, but right now, certainly they are. So we're waiting for this to tip over. Meanwhile, fixed rates have kind of been just chopping up and down. And as of late, they've kind of started to increase again. So I want to dive a little bit deeper into the fixed rate. So I'm just going to zoom in a little bit more here. So we have the black line, which again is the 5-year Canada bond yield. So, we saw rates climb pretty steadily throughout post-COVID. So COVID hit right around here, and we've been kind of rising pretty steadily. And then when we kind of hit October, we started to see the pause and the reversal of rates. This is when inflation generally was coming down in Canada and the US. And so we had this nice move down, and fixed rates dropped roughly from 4.3 to 3.1. So that's about almost a full percent interest rates dropped. But as of late, we've started to see them move up again. So right around by the end of the year, the bond yields were 3.1, and we're currently sitting at 3.7. So we've given back about 0.6, 0.7% on fixed rates as of late. And this blue and yellow line here is just the golden death crosses. So once again, the blue line is the 50-day moving average, and the red line is the 200-day average. And when these cross and creates a red cross or a death cross, that indicates that the trend is moving the other direction. So you can see by here is when exactly the trend changed. So until this blue line crosses back over like it would do here, that's what you would see rates go up. So we haven't quite hit that, but you can tell that based on this trend, we're heading that direction. All of this is to say that fixed rates are moving up. So if you're going to buy a home in the next 4 months, be sure to get a rate hold to prevent any further rate increases, just in case we keep heading in this direction. Now, what's driving the rates up? Inflation is down, so what's driving it up? Well, we have an article here from Canadian Mortgage Trends, and good old Ron Butler at Butler Mortgage indicates that the gains are primarily driven by recent U.S. data, including strong employment, GDP, and inflation figures. So inflation is actually worse in the U.S. than it is in Canada. Their GDP is actually better, and they have stronger employment. So because of that, it's Canada is so reliant on our neighbors down south on a lot of their data. And so sometimes our information doesn't quite get to move, even though our economy might be different than theirs. So just a quick tidbit there. If you look at some of the factors at home, you can see that this is the Canada inflation rate, which we discussed. So it's at 2.9%. So it ticked up from last month at 2.8. Obviously, we're headed in the right direction here, down quite a bit from last April, 4.4. So we're headed in the right direction, but it is being a little stubborn. The Bank of Canada wants that number at 2%. So we're fighting this battle. If you look a little deeper into the inflation numbers, which I won't show you today, but you will see that most of that inflation roughly 25% of that inflation is housing and interest costs, including increased rent. So if you take that out of the equation, we are very close to that 2% target, if not under. So this is sort of a product of the Bank of Canada's own doing. You know, they increased rates, that helped keep inflation up. Gasoline prices have come down. Some of the other big things have come down as well. So, you know, I think it's just a matter of time before the bank actually does cut. The estimates are still coming in around June or July for that first rate cut. Other measures, we have unemployment in Canada. So, you know, unemployment rate jumped up as well to 6.1 after many months around 5.7, 5.8%. So we saw a tick up in unemployment. I think this is a metric that would drive the Bank of Canada to cut rates. It wasn't a massive jump, but certainly the higher unemployment, the more emphasis the bank will place on cutting rates to make life more affordable for folks. Especially if those that aren't working. So another metric to keep an eye on. Then we have the big news of the budget. So the Canadian federal budget came out April 16th, a couple days ago. So I just wanted to highlight a couple things in this budget. They have these sort of three major measures they're going through, but I wanted to highlight the one that would apply to homeownership, which is the budget strategy outlines 3.87 million of new homes by 2031. So I kind of did the math on this, and I'll do it again with you here. So if we have 3.87 million homes, and they want to build that by 2031, which is about 8 years, we divide that by 8, that's about 483,000 homes per year, even just round it down to 480,000 homes per year that they are projecting to be building by 2031. However, if you look at the Canadian housing starts, how many homes they've actually built since the max data we can pull from 1977, the most they've ever built per year was actually here in 2021, March 2021, of 321,000. So they're projecting to build 480,000 homes per year every year for the next 8 years, and we haven't done that in like 45, 50 years. So very lofty expectations by the Bank of Canada to throw these numbers out. My personal opinion is that the Liberal government has not kept many of their promises dating all the way back to 2015. So I think this is just going to be another one of those promises that's not going to come through, especially because of some of the other key measures that they are doing, the increased taxes, which will drive away foreign investment. Some of that investment will certainly be to build more homes. So I think they're playing with fire right now, and I think this government will be on their way out next election in about a year and a half. Other key measures, though, that may help a little bit with homeownership. I want to highlight two of them here. One is the existing home buyers plan. That's that plan where if you have RRSPs, you can withdraw the RRSPs tax-free and repay it within a 15-year period. It was currently $35,000. That's moving to $60,000, and I think that's already in effect. I think it's April 16th that took place. So immediately you'll be able to take more RSPs out. That is, if you even have RSPs as a first-time home buyer. I'd be surprised if any first-time home buyer actually has $60,000. But you know what? That is a positive measure, I suppose. And the other one that is a little bit more interesting is the 30-year amortization extension for first-time homeowners buying newly constructed homes, and this is on insured mortgages only. So right now, the maximum amortization for really anybody buying a primary residence is 25 years if you have less than 20% down. And so this program is allowing you to go to 30 years, which will drop your monthly mortgage payment a few $100 a month. You certainly will pay more interest in the long run because now your loan is 5 years longer, so that debt is just spread out, but it will make it a little bit more affordable for new construction homes only. The interesting thing with this is it's only new construction homes, and on new construction homes you pay GST, and I haven't quite run the numbers on this, but I suspect that the extra cost to pay for the GST, where you wouldn't have to pay that GST on a home that's already built, like a home that's built 5 years ago or 10 years ago, etc. that extra, buffer of 5 years really is just kind of chewing up some of that GST you would pay. So again, I'm not sure this is something that's really going to tip the scales and get more votes for the Liberals, but it certainly will free up a few $100 in the short term if you're a first-time home buyer with less than 20% down buying a new home. So with that, let's end on the rates. So here's a quick scan of the current interest rates. Let's first do insured. So this is for any mortgage with less than 20% down. We'll do a purchase in Alberta, and I'll just leave all the terms open here. So lowest rate overall is still that special that Marathon has of 4.5%. This is a 6-month special only. So, it's a real flashy rate. It's the lowest rate you'll find on any Google search, but it's only good for 6 months, and you have to re-sign with Marathon. Otherwise, you pay a 1% penalty. So this rate aside, the lowest rate on any sort of normal term would be in that sort of high fours, 4.84, 4.89. We have 3 lenders that are promoting that right now, and these are for 5-year fixed rate mortgages. You'll see ATB is leading the way, so that's a 5-year fixed. And Connect First just came out with this recently. Now, keep an eye on those bond yields. They keep jumping, as I mentioned. So if the bond yields continue to climb up, you're going to see those 5-year fixed rates cut as well. So at the moment, if you're buying a home, or if you have a renewal in the next 4 months, or you're buying in the next 4 months, be sure to have a rate hold locked in so you can get that rate if you end up renewing or buying in the next couple months. Now, if we further sort out some of the different interest rates, we're just going to go year by year just to show you the variety. So the 1-year rates are still pretty awful. The lowest rate you can get is 6.7. It goes all the way to 7.44. The 2-year is a little bit better, but not much better. 5.64, 6% really on most of them, and all the way up to 7%. So between 6 and 7 for a 2-year rate. The 3-year seems to be a sweet spot. You can still get a 4.99% rate with 2 lenders. That range is pretty high, all the way up to 5.8. This seems to be a pretty popular choice right now. And then again, you got the 4-year, which is sort of another in between, 5.14, so slightly higher, 1 extra year. And then you get usually the lowest rates in that 5-year bucket, which is those 4.84s we discussed. Some of the banks are a little bit higher. TD's, quite a bit higher than an ATB, for example. Just to show you the 10 for variety, I would definitely not recommend signing a 10-year fixed right now, as we expect rates to come down. But just so you can see, it's about 6%. And then lastly, it's the variable rate. So these are your floating rates. These are the rates that are based on the Bank of Canada overnight rate. So when the Bank of Canada does eventually start cutting, it will impact these rates here specifically. So the lowest rate is 6.2 with 2 lenders, and that goes all the way up to 7%. So in this regard, ATB is not very competitive, but they seem to be pretty competitive with the fixed rate options. So that's insured business only. And just to show you what the difference would look like if you had, let's say, 20% down payment. So if you have 20% down payment, you can skip the CMHC insurance fee, but the rates do start at 5.24 instead of that 4.84. So something to keep an eye on. We run the math on this all the time. You're still much better off paying the higher rate and saving the insurance fee by putting 20% down. So don't be too scared away by these rates, but just know that the rates are higher based on the amount of down payment you have. So that's a big difference. That's it for me. Hope this was insightful. If you have any questions, drop them down in the comments. Otherwise, best of luck this month, and we'll talk to you later. Bye-bye.